When you look at the modern South African financial landscape, you're looking at an incredibly complex, multi-layered system. A common service these local managers offer is giving you exposure to offshore markets, but there is a specific catch to how they usually do it. Instead of managing the money themselves, local funds typically hand your capital over to an entirely separate third-party manager based overseas. This flowchart tracks what happens to that capital. As the money moves from the local fund to the offshore manager, it passes through layers of middlemen. At each step, administration costs, third-party cuts, and secondary management fees are extracted. The result is a structure that actively bleeds the exact yield you were trying to capture in the first place. Herenya Capital takes a different approach. We run a specialist offshore portfolio, and we invest that money directly. When we remove the outsourced third parties, the friction disappears. There is no handoff. By cutting out those secondary fees, a much larger percentage of the original capital is retained in the portfolio to actually generate returns. Direct management removes the structural drag on your investment. Operating a portfolio without a third-party safety net requires specific internal infrastructure. Our investment committee is built on decades of practical market experience. Petrie and I have navigated these markets together for over 15 years. Over that time, we've developed a highly curated network. We track specific global analysts and know exactly where to find the most accurate institutional research. We filter that data internally to generate our own ideas and position the portfolios directly based on the actual math. That established intelligence pipeline is what makes direct offshore management viable without relying on an outside manager. Once the capital is deployed, internal risk management becomes a strict exercise in position sizing. Looking at this diagram, you see a common industry hazard, allocating 30% of a portfolio into a single stock, hoping to hit a home run. We reject that model. We distribute the capital across much smaller, highly stable allocations. A standard position sits at 1, 2, or 3%. Even with our absolute highest conviction ideas, we cap the allocation at 4 or 5% of the total portfolio. We build structural stability through absolute mathematical restraint. Internal sizing controls deal with individual stocks, but portfolios also face external macroeconomic shocks that no analyst can control. Tensions in regions like Iran can escalate without warning. When conflict threatens global supply chains or energy reserves, that stress instantly transmits into the financial system. The broader markets come under intense pressure, triggering steep, rapid drawdowns across almost all sectors. Because severe external shocks are guaranteed to happen, your investment vehicle must be explicitly engineered to survive them. To defend against those freefalls, we deploy specific hedges. We incorporate options contracts and the VIX, an index that specifically tracks market volatility. When the market drops sharply and volatility spikes, the falling portfolio value hits our hedge parameters. The VIX and options positions trigger, arresting the fall. Minimizing deep drawdowns ensures your capital baseline remains intact, even under extreme market stress. Everything we do is driven by one absolute rule: protect capital first. Only after downside risk has been systematically neutralized can we focus on growing your wealth.